This is Barry Knapp with Ironsides Macroeconomics. This is your complimentary abbreviated version of our weekly summary, our weekly note. The note this week was titled Three Arrows. It was a bit delayed due to a travel schedule last week. Three Arrows is an obvious reference to the Treasury Secretary nominee, Scott Bessent. We wrote initially about the transition at the Treasury and our perspectives on that. We then dug into supply side economics and the transition we're about to undergo from what Treasury Secretary Yellen called modern supply side economics. We call either industrial policy or government control over the means of production to more broad-based tax incentives where the market gets to decide how to allocate the capital over time. We then discuss the data that we saw last week, the data that we're really focused on in the next couple of weeks, and then just some final thoughts on the market. So just to start, Treasury Secretary Yellen left Mr. Bessent an absolute debt bomb. The excessive liquidity injections in 2021 from Treasury Secretary Yellen's decision to draw down the Treasury General Account, the excessive purchases by the Fed, the $1.9 trillion stimulus, in our view, is the single biggest cause of the inflation shock. And her subsequent decisions to fund much of that debt with Treasury bills, essentially rolling the dice on inflation being transitory and the Fed being able to cut all the way back down to below 3%, we think left incoming, assuming he's approved, incoming Secretary Bessent with a bit of a mess. And he would have been our first choice had we had a say in all this. So far, and we wrote about sequencing last week, he sounds like, based on his first interview, which I believe was with the Wall Street Journal, that the first order of business is making the Tax Cuts and Jobs Act permanent. This to us is absolutely crucial. Before they get to trade policy, let's ride a potential positive business confidence shock by going back to these broad-based tax incentives, locking in a low corporate tax rate, and perhaps more importantly in the long run, getting the debt on the right trajectory over time. So part of his three-arrow strategy is targeting a 3% budget deficit by 2020. So that, for us, is absolutely crucial. If you can stabilize the back end of the bond market, bide yourself some time. And so far, the market seems pretty confident, at least on the day, that he can do that. We're having a pretty good rally in the back end of the Treasury market and a little bit of a weakening of the dollar. So that's pretty good news from that perspective. But if they address these things first, that will create a policy space to then go after trade policy and our uneven lack of reciprocity across the rest of the world with our major trading partners like Germany, China in particular. So that's in on that. Then we then moved on to talk about supply side economics and how we've had weakening trends in all the major components of non-residential fixed investment for the better part of the entire Biden presidency. We've seen weaker R&D spending. We've seen weaker equipment spending, notwithstanding a little bounce last quarter because of some airplane orders, weaker spending on structures, and weaker spending on software. So we do, though, see some signs from the first handful of regional Fed manufacturing and non-manufacturing surveys for the month of November post-election. There is a decent bounce underway in 6-month forward capital spending plans, expectations of orders, even a little bit of a pickup in employment. So we'll see, but so far it looks like we might get a business confidence bounce that could facilitate a rebounding in capital spending as we move through the balance of the year and, of course, into 2025. We then went on to discuss a little bit of the data we saw last week. Housing data, we saw a really interesting report from the Cleveland Fed that implied we don't actually have the turnover in the housing market to really get those current rents that are running quite soft to feed into the indices. And as we've noted, the Fed really impaired the supply of housing. And so we don't think we're getting back to 3% trend rent of shelter inflation. Um, the big issue, though, here going forward is the labor market data. Tomorrow's labor differential from the Conference Board's Consumer Confidence Survey is big. And then, of course, next week's data is huge. We actually think the underlying tone of the labor market's fairly weak. That, if we're correct, that'll get the Fed to cut in December and cut in January. Passing on those cuts, we think, and slowing the process down would be a major mistake. It's going to put a lot of pressure on small businesses and set them up for a bit of a conflict with the incoming administration. So a couple of weeks ago, right after the election, we took down healthcare. We added a little bit to the Russell. We're now market weight there. We increased our exposure to financials. So far, so good on those calls. And we'll be getting at our Outlook note a week from Friday. We'll be releasing the first of 3 of those. So have a week, everyone. Happy Thanksgiving. Barry Knapp from Ironsides. Thanks for listening.